So we'll compare the answers. So first is the fair value of the retained investment now, because entire percentage, because you have become an investment entity. So you stop the consolidation. So first you take 25 lakhs. Net assets disposed including goodwill 19 lakhs plus 4 lakhs. No confusion, no? So many assets values they have given. So you get the gain on the change in the investment status. Clear? Any mistakes here? Anyone? Sorry? What goes out of your book balance sheet? Book value of net assets. When assets come, you take it at fair values. What goes out is the book value. This is what we have discussed in the loss of control accounting. Yes, clear, no? So next question. On 1st April 2021, P Limited acquired interest in S Limited for 75 when the fair value was 60, goodwill was 15. They disposed of 80% as on the date carrying amount of the net assets excluding goodwill. Fair value remaining interest is so and so. See, this question came in your May 23 exam. Simple, easy question. That's why we cannot ignore it, Baba. Somewhere sitting, hiding somewhere. See, this question may come like this and say, clean. They just calculate the gain or loss, pass the necessary entries for disposal of 80% in piece, separate and consolidate. One twist, small twist they gave you in the examination. Yes, can you pause the video and do this? Yes, sure. So we'll check the answers. See, this is a 5-mark question in the examination. Calculate the gain or loss. Maybe they are asking in SFS and P and this thing. So calculate the gain or loss. They may be asking. They didn't tell you specifically where. So you should have done at both the places. Journal entry also you should have given at both the places. Then I don't know how the mark allocation works here. So did you make the gain or loss on sale of parents SFS 54? Sale proceeds was 114, and your proportionate investment is it a proportionate investment? You had 100% and you sold 80%. So what is the 80% of the 75? 60. So you got 54. Your journal entry will be bank account debit 114. Investment in associate is going to, because you retained it in your SFS, but you going forward you call it investment in associate 20%. Investment in subsidiary, or if you say to investment, somebody could have shown net also. That means 60 goes out. So what remains is what is retained now in SFS. But and gain is subsidiary. My only one question, have you passed this entry? See, again remember students, learning for us, my guess also, when a journal entry is a predominant thing in the question, don't write in a bracket P and L. It's same like in AFM also I tell you, when a question is predominantly based on one equation, explain the equation. If it's a one big working you need to do where we all need to equations, say for example, value of the share, dividend discount model. You say D1 divided by KE minus G, P0 is equal to this equation you say. Do you need to explain what is D1, what is KE? Not required. But if the question predominantly comes on this, you have to explain what is P0, what is D1, otherwise you are going to lose the marks for something what you know very well. So this particular thing, since the journal entry is the predominant thing, with the narration, have you written narration or at least being? Make a practice. Other places, okay, take the risk there, but at least this question you cannot take the risk. Now, alternative answer they said, let us try to understand what they are trying to tell here. They say that in case of partial disposal of the investment leading to significant influence, but you lose the control, you can, the above solution has been provided by following proportionate approach. You have done the proportionate approach, no? How much associate went off? Proportionately you disposed of. However, cost of the retained investment has not been defined in Ind AS 27 because 27 comes into picture now. Still, since it is an associate, 27 still applies. But 27 doesn't say what is your cost of the retained investment in SFS. Therefore, para 10 of 11A of Ind AS 8, that is absence of accounting policy that specifically applies to this, which is designed by the management. Consider the application of requirement of Ind AS dealing with the similar para number 25B, all confusion, okay. Recognition of investment in the former subsidiary to be at the fair value. So, if the cost is not defined, you assume cost is the proportionate cost, that's fine. Alternatively, a company can define, a management can define what is the cost. Fair value itself is the cost on the initial recognition of a financial asset, because generally, see, 109 says what? When you recognize any asset for the first time, what value? Fair value, no. Are you not recognizing in your standalone financial statement an associate for the first time? Are you not recognizing? Then why you are taking at cost there? Doesn't, see, that's what they say, alternatively possible. Because associate comes for the first time, you can recognize at the fair value also, as per 109, because Ind AS 27 is totally silent on what is cost. So if some students would have assumed that I will recognize my investment in associate which comes for the first time at fair value, the fair value of the retained investment would have been 28.5 and my gain would have come down to 67.5. So in that case, my journal entry would have been 114 and nobody can change these two numbers. But the fair value, if you increase, that much gain is going to come down. In that case, what you transfer to P&L account is only 67.5. You followed this methodology, doesn't matter. They said, okay, good, at least they showed me, otherwise you would have asked me this question and I would have told it's an assumption or whatever. See, very specifically, they told you about the paragraph numbers also. In the CFS level, sale proceeds is 100 and 20% retained is 28.5. This is what we know, loss of control. Net assets is 13.35, you got 7.5, correct? Then you pass the journal entry bank account debit, fair value of the identifiable assets 28. Net assets of the subsidiary, goodwill 7.5, 7.5 to 7.5. All these journal entries are perfect. 4 marks total, if all these things are done. If P&L entry, if you are not passed this entry, understood, maybe you may get 5 or 4. If students have written these two separately, damn sure they are going to get 5. If you have not done this, you may get 5 or 4. That depends upon, I don't know what instructions has been given to them. If examination goes very tough, they may say, okay, even though you don't pass this entry, give 5 marks. If the examination is very simple that year, FR, they say correction, make it very tough. That's why don't go with what happens to you in the examination. Followed, no? Yes, there's one last theory question. With this, we'll wind up with this Ind AS 110. So we have discussed all the theories of Ind AS 110, which is hardly 12 questions, okay? If you please practice this one first. There's one question on loss of control, which is they have given in your test your knowledge 12. Now at the beginning of, see, please understand this, very nice, very beautiful question. At the beginning of the current financial year, AB already holds 90% of shares in BC. Now BC is your subsidiary. During the financial year, AB sells 70% of the stake to PQR. That means you have lost the control. Still 20% you retain. Previously there was 10% NCI for a total consideration of 56 crores. So you got for 70% sale 56 crores and lose the control. At the date of disposal, the fair value of the 20%, this 70 minus 90, is 16 crore and net assets of BC, which is sitting in your financial statement, is 60 crores. So you have all the information. If at all, if I ask you, pass the journal entry, you would have said purchase consideration account debit, how much? 56. NCI is how much? 60 crores into 10%. Fair value of the retained investment, 16 crores. To net assets, 60. Was there a goodwill at the beginning? God knows. Leave it. Differential figure you would have taken to P&L. Now, these net assets included debt investment classified at FVOCI. Oh, this net assets has got certain breakup, PP and all so many things. But there is one debt at FVOCI 12 crores and OCI reserves are 6 crores. What are you supposed to do now? When you credited 2 minus FVNA, Along with this 60, 12 also went off. But what about this 6? You have to recycle. What accounting entry you will pass? FVR, okay, very easy. Is it a credit reserve or debit reserve? Credit reserve. You will debit that and credit what? How much? See, first of all, 100% should go off. Because your investment itself is not there in the subsidiary. In CFS, only one item should come called investment in associate going forward or whatever. 100% of 6 you have to debit. But when you credit, how much you will credit to parent? 90% no. Because have you not given the share of 6 rupees to that NCA also? So there are two breakup here, 90 and 10. 10 you will not reverse. Why? Because the moment NCA gets reversed, this 10 also got reversed, no, automatically. See, when you took a share from the subsidiary of OCI, what accounting entry you must have passed? You took a share of OCI from the NCA subsidiary. Your accounting entry would have been the fair value reserves, whatever came, whatever investment account debit, fair valued, debt investment account debit, to fair value reserve, how much? 90%, to NCI 10%. That means when you reverse this NCI, the 10% will automatically get reversed. So what you need to do now, only accounting entry only for that 54, 90% of that. Because that is sitting in your CFS. Have you understood this? That's why I'm telling you, very beautiful question. Never ever we came across this. Only in one test your knowledge they have given this. You'll see that. I'm just explaining you. There is one defined benefit liability of 6. Same thing, its liability is 3. Net remeasurements. 90-10. But this is no recycling. Retained earnings. This is P&L account. Why? Because this is a debt FVOCI. Sorry? Full 6 will not go, Baba, because you never invested 100% here. Yeah, because right now what is reflecting is my share only, no? That only I will do. That's exactly. NCI will not do, no. Because when you took over the subsidiary, you prepared 100% consolidation. You took their asset, you took our assets, you added. So literally, what is the accounting entry for the debt related thing? You passed debt instrument account debit, whatever amount. How much? 6. Cost you have taken previously. This year there was a fair value increase. So when the fair value increase was there this year in the subsidiary, you debited investment in the debentures. 2, share of OCI, how much? 5.4. 2, NCI, 0.6. Today's day, you do this, what is it called? Loss of control accounting. You debit NCI account debit. That means this 0.6 portion of that 6 is already getting reversed along with one single balance of NCI. Net assets will go to net assets. Whatever, 6 will go off. Purchase consideration, you must have got something. Difference will go to P&L account. But only one question comes, your share of OCI sitting in your other equity, no. What you will do? That is the only thing you have to reverse now. In that share, your share is 90%, no. 6 is entire subsidiary is 100%. 6 is full 100% of subsidiary. Out of that, you took your share, which is sitting in your balance sheet, and the portion you give to NCI. Not my share. Okay, don't misinterpret it. It is the 100%. My share is 90% of it. This is what, okay, let us read it. Is it language gives me that impression? Debt investment classified through FVOCI. The net assets include. Clear, no? Net asset means, is it my share? No, it's 100%. When you say net assets, is it not 100% here? Where both the parties have got a share, 90 and 10. Now, this is subject to recycling. This is subject to no recycling. Equity instrument was there with the FVOCI. Again, you have to break it into 90 and 10, but it is no recycling. You have got a foreign currency operations translation reserve. Again, you have to break into 90 and 10, but it is subject to recycling. In a CFS of AB Limited, 90% of the above, see, spoon feeding, huh? Don't go with this, huh? In here they said in CFS, 90% of the above reserves were included in the equal whatever reserves with the 10% attributable to the NCI. Don't expect that this sentence they will give in the examination. Now it's very clear, no? What would be the accounting treatment on loss of the CFS? In exam they may ask you general entry because in the solution they have given the general entry. So your answer will be same story we will write. How do you account the loss of control? We say loss of control, we are going to derecognize the subsidiary including goodwill, derecognize the NCI, recognize the gain or loss, recognize the investment retained at a fair value. This is a standard answer we will attach to everything there. Further, which we never wrote any answer because never we came across OCI. In case the parent shall account the previously recognized OCI in such a way, the same basis as if it would have directly disposed of the related assets and liabilities. That means since it is my asset, what if I would have sold my debt? I would be subject to recycling. So I should treat when the loss of control happens as if I should see I have sold my subsidiaries that one particular asset only. What treatment I would have given? I should give the same. So parent has to reclassify the OCI items in the thing. So now let us talk about the debt FVOCI reserve. This you need to reclassify to P&L account as per Ind AS 109. However, you will reverse only your portion, that is 50%, and remaining 10% is already sitting in the VOCI, NCI. You need not pass any entry because the moment you debit NCI, that much value goes. Remeasurement reserve, you need to transfer to the retained earnings because it is not subject to remeasurements. It is not recycling. However, how much? Only 90% of your share. It is not reclassified to P&L account. 10% of that NCI, no, you don't touch it because it is already sitting in NCI, it got reversed. Have you understood? Same story, equity OTI reserve also, you should reclassify to retained earnings because it is not subject to recycling. You need to, but don't touch NCI because it is already sitting there and it got reversed. And foreign currency translation reserve has to be taken to P&L account. And remaining 10% you don't touch because you have already allocated to NCI and it has got reversed. So the journal entries will be bank, if at all they ask you, bank 56, NCI 6, investment at FVOCI 16, net assets 6, you got 60% of this, and gain on disposal will be 18. Along with this, 4 more entries you need to pass. FVOCI reserves to PL 5.4 for that debt FVOCI, retained earnings to net remeasurement because it was a loss to you. Be careful, huh? Don't pass everything to retained earnings. One they will give us a profit, one they will give us a loss. FVOCI reserve is a profit, you transfer to retained earnings, and foreign currency translation reserve you transfer to P&L account, only your share. So at the end they may ask you what is the impact on the P&L account. My impact on the P&L account is 5.4 plus 7.2 plus loss of control, so total 30.6. What is your impact on retained earnings? There are only 2 entries which is affecting my retained earnings, so 0.9. Are you clear? Perfect. Understood consolidation? Simple. Come on, simple now. So with this, I would like to show you one beautiful slide which always I wished should come for every standard, which is thank you.